Hello everyone. Today we will talk about creating a solid financial plan. A well-designed financial plan is crucial for launching and managing a new business venture. Potential lenders and investors typically expect to see a financial plan before committing their resources, as it demonstrates the business's viability and the entrepreneur's seriousness. Beyond attracting funding, a financial plan serves as an essential management tool, allowing entrepreneurs to navigate challenges and avoid common pitfalls that can lead to business failures. By understanding the assumptions behind their financial models, entrepreneurs can recognize when actual performance deviates from forecasts, enabling timely corrections. Neglecting financial planning can result in companies becoming part of failure statistics. Empirical studies have established a clear link between thorough financial planning and the success of new ventures. Companies that engage in formal planning tend to experience better financial performance, highlighting the significance of having a structured financial approach. Many experts caution that entrepreneurs who lack sound financial controls risk setting themselves up for failure. Despite the importance of financial planning, entrepreneurs often face significant challenges in this area. A primary reason for this low level of financial planning and analysis is a lack of financial knowledge. Many small business owners find accounting intimidating, and a substantial number report having no formal financial training. Additionally, some view financial tasks as tedious, leading to a neglect of vital data that could guide important business decisions. This lack of engagement can undermine their understanding of the business's overall financial position and hinder their ability to respond to changes over time. To address these challenges, the chapter aims to provide practical tools and techniques for creating effective financial plans. Entrepreneurs will learn to prepare projected, pro forma, financial statements, conduct ratio analysis, and perform break-even analysis. By mastering these techniques, they can better understand and manage their business finances, anticipate changes, and develop appropriate strategies for achieving profitability. Financial acumen is essential for successfully navigating the complexities of running a business and enhancing the likelihood of success. Before diving into projected financial statements, it's essential to understand the basic financial reports that measure a company's overall financial position: the balance sheet, the income statement, and the statement of cash flows. Preparing these statements is beneficial for businesses of all sizes and forms the foundation for securing their financial future. To streamline the process of creating these reports, many accounting experts recommend using popular accounting software like Intuit's QuickBooks, Sage 50, or its cloud variant, Sage 1. These programs are designed to manage routine record-keeping tasks effectively. However, a Microsoft survey found that less than half of small businesses utilize dedicated accounting software. Most rely on homemade spreadsheets and paper records. Using accounting software can significantly reduce calculation errors and facilitate the generation of reports and analyses that inform better decision-making. Collaborating with an accountant to establish a solid accounting system and then having an employee or part-time bookkeeper manage transactions is often the most efficient approach for businesses using these tools. Now, the balance sheet. The balance sheet acts like a digital camera, providing a snapshot of a business at a specific point in time. It has two main sections: assets and liabilities, along with owner's equity. Typically prepared at the end of each month and fiscal year, the balance sheet follows the fundamental accounting equation: assets equal liabilities plus owner's equity. Assets equal liabilities plus owner's equity. Any increase or decrease on one side of the equation must correspond to an equal change on the other side, which is why it's known as a balance sheet. It serves as a baseline for measuring future changes in assets, liabilities, and equity, or net worth. The first section of the balance sheet details the company's assets, valued at their original cost rather than current market value. This includes current assets, cash and items expected to be converted into cash within a year, such as accounts receivable and inventory. Fixed assets, long-term items like equipment, furnishings, and buildings. Intangible assets, non-physical assets with value, such as goodwill, copyrights, and patents. The second section outlines the company's liabilities, which are the creditor's claims against its assets. This includes current liabilities, debts due within a year, including accounts payable and short-term loans. Long-term liabilities, debts due after more than 1 year. This section also displays owner's equity, representing the owner's investment in the business. It includes all capital contributions and retained earnings not distributed to the owner. This equity is the balancing factor on the balance sheet, indicating the overall financial health of the business at a specific date. The income statement, also known as the profit and loss statement, provides a comparison of expenses against revenues over a specified period, ultimately revealing the firm's net income or loss. Serving as a moving picture of a company's profitability, the income statement illustrates financial performance over time. Typically, an annual income statement summarizes the business's results for the fiscal or calendar year. To calculate net income or loss, business owners begin by recording sales revenue, which encompasses income generated from selling goods and services, along with revenue from other sources like rent or investments. Net revenue is then determined by subtracting the value of any returned items or refunds from gross revenue. The cost of goods sold, COGS, represents the expenses incurred in purchasing merchandise that the business sells during the year, including shipping costs. Businesses that sell products calculate COGS by adding purchases to beginning inventory and subtracting ending inventory. Service companies, on the other hand, typically do not have COGS. By subtracting COGS from net sales revenue, a company arrives at its gross profit. Monitoring gross profit is crucial. If these costs become unmanageable, gross profit declines, leading to a potential net loss. The gross profit margin, calculated by dividing gross profit by net sales revenue, is a key metric for entrepreneurs. If this margin falls too low, the company risks operating at a loss, which can restrict investments in vital activities like marketing and development. Many entrepreneurs mistakenly assume that inadequate sales volume is the primary issue and focus solely on boosting sales. However, a low gross profit margin is often the real culprit, and merely increasing sales can exacerbate losses. To address a poor gross profit margin, companies may need to increase prices, reduce manufacturing costs, reject low-margin orders, or introduce more profitable products. One entrepreneur who initially focused on boosting sales only to incur greater losses learned the importance of tracking gross profit margins diligently. Operating expenses consist of costs related directly to the manufacturing and distribution of goods, while general expenses represent indirect costs of running the business. The net income, or loss, is calculated by subtracting total expenses from total revenue. Reducing expenses can enhance net income, with even minor reductions yielding significant savings. However, cost-cutting measures must be strategic. While minimizing costs can improve profitability, indiscriminate cuts can be detrimental. For example, Brad Smith, CEO of Intuit, emphasizes the importance of maintaining investment in research and development, as innovation is crucial for the company's success. Cutting costs in vital areas, such as marketing, can hinder competitiveness. Research indicates that companies that continue advertising during downturns outperform those that do not. Cost-cutting can also affect employee morale. When management reduces small, meaningful perks while retaining lavish expenses for themselves, it can lead to discontent among employees. A notable example involved a CEO who slashed the budget for the company Christmas party and micromanaged minor expenses, losing credibility in the eyes of employees who observed a disparity between spending on themselves and necessary budget cuts. The statement of cash flows provides a detailed account of the changes in a company's working capital over a specific accounting period. It outlines the sources and uses of funds, helping business owners understand how cash flows in and out of their organization. While many small businesses may not require a formal statement of cash flows and can instead rely on a simpler cash budget, certain stakeholders, like creditors, lenders, investors, or potential buyers, might request this information. To create a statement of cash flows, owners begin by gathering the year's balance sheets and income statements. They start with the net income for the period, as reported in the income statement. Next, they identify various sources of funds, which may include borrowed funds, owner contributions, decreases in accounts payable, declines in inventory, and depreciation. Notably, depreciation is treated as a source of funds because it represents a non-cash expense. Although it reduces taxable income, the actual expense was incurred in prior purchases. Owners then move on to subtract the uses of these funds, which can comprise expenditures on plant and equipment, dividends paid to owners, debt repayments, increases in accounts receivable, and enhancements in inventory. The net effect of these calculations reveals the increase or decrease in working capital. By analyzing changes in working capital and the reasons behind them, entrepreneurs can develop a more practical financial action plan for the future. These statements serve a critical function beyond mere accounting requirements. When combined with analytical tools, they aid entrepreneurs in mapping out their companies' financial trajectories and planning for profitability. However, simply preparing these statements isn't enough. It's essential for business owners and their teams to grasp and effectively utilize the information contained within them. This understanding can lead to improved operational effectiveness and efficiency, ultimately fostering the growth and sustainability of the business. Creating projected financial statements is a vital step for entrepreneurs aiming to turn their business goals into reality. These statements help answer crucial questions related to profitability, sales levels needed to achieve profit objectives, and expected expenses at various sales levels. Understanding these elements lays the groundwork for a solid financial plan. The focus here is on creating projected income statements and balance sheets, which estimate the financial health and profitability of the business in the near future. These statements are essential for convincing potential lenders and investors to provide the necessary funding for startup or expansion efforts. In essence, they help entrepreneurs plan pathways to improved financial strength and growth. For established businesses, creating these statements is easier due to historical data. In contrast, startups often rely on industry statistics to guide their projections. Sources like the RMA's annual statement studies provide valuable benchmarks. Entrepreneurs should also develop a robust business model and plan to create realistic financial forecasts, focusing primarily on the first 2 years. When launching a business, determining the required capital is critical. This entails covering all startup costs, such as rent, equipment, salaries, advertising, and other operational expenses, as well as maintaining a financial reserve until the business achieves positive cash flow. It's important for entrepreneurs to recognize that initial expenses often exceed income, leading to cash flow challenges. Many entrepreneurs underestimate these challenges, but it's common for the initial phase to involve losses that can persist for months or even years. Okay, now projected income statement. The projected income statement begins with a sales forecast, which can be approached in 2 ways: determining sales based on a profit target or developing forecasts based on expected sales levels. Many entrepreneurs prefer the profit target approach, which aligns their business size and goals. However, verifying the sales target against the marketing plan is crucial to ensure its feasibility. Next, entrepreneurs estimate the expenses tied to generating those sales. The resulting profit must not only cover the owner's time, but also provide a reasonable return on their investment. For instance, if an entrepreneur has a significant amount of capital that could yield a return elsewhere, it's vital that their business provides at least a similar financial benefit. Estimating this target income is vital in developing the income statement. Once the profit target is established, entrepreneurs can translate that into a sales estimate using industry benchmarks. For example, if a potential flower shop aims for a specific profit, they can ascertain their required sales based on industry standards. To assess the practicality of the projected sales, further analysis is beneficial. Breaking down annual sales into daily averages provides clarity on performance expectations. This helps the entrepreneur understand how much revenue needs to be generated daily and hourly, making it easier to strategize efforts to meet those sales goals. In developing the projected income statement, entrepreneurs also need to closely examine operating expenses. Using industry publications can provide insights into typical expense percentages. However, the most accurate estimates will be those tailored to the entrepreneur's specific location and circumstances. Thus, thorough research and possibly consultations with accountants are advisable. Alongside the income statement, creating a projected balance sheet is essential. This document outlines the company's assets and liabilities and helps entrepreneurs ensure they understand what resources their businesses need. Many new businesses falter because they fail to adequately assess their total asset requirements. Cash is a critical asset, and determining the necessary cash balance at startup can vary by business type. A useful guideline suggests that cash should cover operating expenses, excluding non-cash items like depreciation, for a full inventory turnover period. This rule of thumb aids in cash planning. Inventory levels should also be carefully considered. They can be estimated based on projected sales and industry benchmarks, ensuring the business has what it needs to operate efficiently. Entrepreneurs must consider all types of assets, including necessary fixtures, equipment, and miscellaneous items. Liabilities are equally important. They represent claims against the company's assets. Entrepreneurs should document all financial obligations, including loans or credit extended by suppliers or individuals. Okay. Now let's talk about ratio analysis. Relying on a financial dashboard is crucial for small business owners, much like monitoring a car's dashboard while driving. Just as drivers need to keep an eye on fuel levels and engine temperature to avoid breakdowns, entrepreneurs must pay attention to their financial metrics to prevent business failures. Many owners neglect these financial indicators, which can lead to significant trouble before they even realize it. A solid financial plan is just the starting point. Consistent monitoring through financial controls ensures that a business remains healthy and on course. A well-functioning system of financial control serves as an early warning system for potential issues that could jeopardize a company. By allowing entrepreneurs to step back and evaluate the bigger picture, these systems help in making strategic adjustments when necessary. Key indicators, such as declining sales, increasing overhead, and growing inventories, can signal trouble ahead. Recognizing these signs is essential because a decrease in cash flow can lead to delayed payments to vendors, maintenance issues, and eventually, degraded productivity. To effectively interpret financial data, entrepreneurs often turn to ratio analysis. This tool allows them to understand the relationships between various accounting elements, serving as a barometer for a company's financial health. Ratios help identify issues such as excessive inventory levels, high operating expenses, and slow customer payments, which are critical for efficient business management. Unfortunately, many business owners overlook the importance of financial ratio calculations and fail to use them for effective oversight of their companies. By consistently tracking these ratios, entrepreneurs can identify problems before they escalate into crises. This proactive approach not only aids in problem solving, but also enhances chances of securing external financing. Lenders often examine these ratios to assess a company's management quality and financial stability, making financial analysis an invaluable skill for entrepreneurs. When it comes to monitoring ratios, the number tracked should remain manageable. While theoretically, the number of ratios is limitless, too many can create confusion. Successful financial management requires simplicity, focusing on key indicators that clearly illustrate a company's financial standing. Okay, so now what are the key ratios? Within the framework of ratio analysis, 12 key ratios emerge, grouped into 4 categories: liquidity, leverage, operating, and profitability ratios. Liquidity ratios. Liquidity ratios assess a company's ability to fulfill its short-term obligations. They provide insight into potential cash flow problems, allowing entrepreneurs to make timely decisions. Healthy liquidity not only enables timely bill payments, but also positions a company to seize advantageous opportunities when they arise. The current ratio and the quick ratio are the two most prominent liquidity measures. The current ratio reflects a small business's solvency by comparing current assets to current liabilities. It shows how easily a company can cover its short-term debts with its short-term assets. In contrast, the quick ratio provides a more conservative view by excluding inventory from the equation, focusing instead on assets that can be quickly converted into cash. This broader perspective offers a clearer picture of a company's liquidity and financial stability. Leverage ratios. Leverage ratios measure the proportion of a company's financing that comes from debt compared to that provided by its owners. They indicate the financial risk associated with a company's debt levels. A high leverage ratio signifies that a greater portion of assets is financed by creditors, which might result in higher potential profits during boom periods, but also greater vulnerability during downturns. Monitoring these ratios helps ensure that debt levels remain manageable and do not jeopardize the business's financial security. The debt ratio reveals the percentage of total assets financed by creditors. In contrast, the debt-to-net worth ratio illustrates the relationship between liabilities and tangible net worth, indicating the level of financial protection for creditors. The times interest earned ratio measures the company's ability to meet interest payments on its debts, providing insight into the financial cushion available to cover these costs. Operating ratios. Operating ratios help entrepreneurs evaluate the efficiency of their companies in utilizing resources. They identify areas requiring improvement to maintain competitiveness. For instance, the average inventory turnover ratio tracks how often a business sells and replaces its inventory. High turnover indicates effective inventory management, while low turnover suggests problems such as overstocking or obsolescence. The average collection period ratio monitors the average time it takes to collect receivables, while the average payable period ratio reflects how long the company takes to pay its suppliers. Together, these ratios help manage cash flow, ensuring that the timing of cash inflows and outflows remains balanced. Profitability ratios. Profitability ratios gauge how efficiently a company is being managed and its ability to generate profits. These ratios give a glimpse into the company's net income relative to its sales, assets, and equity investments. The net profit on sales ratio shows how much profit remains from each sales dollar after expenses, while the net profit to assets ratio measures the return generated per dollar of assets. Finally, the net profit to equity ratio reflects the return on the owner's investment, helping entrepreneurs assess their management effectiveness and the viability of their business model. Interpreting business ratios. Ratios serve as vital indicators for measuring a small company's performance and can help identify potential problems before they escalate into serious issues. However, merely calculating these ratios is insufficient. Business owners must understand how to interpret them effectively to manage their operations efficiently. This involves recognizing which ratios are crucial for their specific industry, as the significance of different ratios can vary widely across sectors and within different segments of the same industry. Successful entrepreneurs often create or adapt key performance indicators, KPIs, tailored to their operations. These KPIs track both financial and operational aspects, acting as barometers of success. For example, metrics such as average collection days, food costs as a percentage of sales in restaurants, or hotel occupancy rates are critical for gauging performance relevant to each business's unique objectives. Monitoring these KPIs allows entrepreneurs to stay aligned with their goals. One of the most effective uses of ratios is to compare them with industry averages. This contextualizes a company's financial metrics, aiding business owners in pinpointing problem areas and devising improvement strategies. Much like a doctor uses medical tests to evaluate health, entrepreneurs should look at their financial ratios to ensure they fall within acceptable ranges for their industry. Deviations from these norms, whether positive or negative, merit investigation to discern their causes. When comparing ratios to industry standards, business owners should ask several critical questions. Is there a significant difference between their ratios and the industry average? If so, what is the nature of this difference? Understanding whether the deviation is beneficial or detrimental and identifying its causes helps in deciding if corrective actions are necessary. By leveraging ratio analysis appropriately, owners can uncover potential issues early, mitigating risks before they threaten the business. Various organizations compile and publish operating statistics, including key ratios that summarize the financial performance of companies across industries. Resources like BizMiner, RMA Annual Statement Studies, and Dun & Bradstreet's Key Business Ratios provide valuable benchmarks that can inform strategic decisions. In practice, learning to interpret financial ratios involves comparing a company's metrics to those of similar businesses within the same industry. For instance, comparing Sam's Appliance Shop's ratios against industry averages allows the business owner to calculate variance and identify discrepancies. It's important to aim for performance that meets or exceeds these averages, as doing so signals a healthy competitive standing. However, significant variances from the average do not automatically indicate financial distress. Entrepreneurs need to delve deeper into their financial data to understand the underlying reasons for these discrepancies. For example, a surge in expenses might be a strategic decision rather than poor management. Regular analysis of financial statements helps track trends over time, allowing owners to notice gradual changes that might otherwise go undetected. Lastly, entrepreneurs should recognize that ratios are more than mere numbers. They encapsulate the health and direction of the company. By mastering ratio analysis, business owners can gain insights into their operations, enabling sound decision-making and effective management. Thus, developing financial acumen through ongoing education, analysis, and adaptability becomes paramount in maintaining a competitive edge in the market.
Thank you for watching. If you liked this video, please like and subscribe to channel.